So thank you, IT. I'm going to call this meeting to order. We're not going to do roll call. We'll mark everyone's attendance. Good morning. I'm State Senator from Michigan, Lana Theis. I'll be chairing the meeting today. I'd like a motion to waive the quorum requirement. We have a motion and a second. Motion to approve the April 12, 2024 meeting minutes. We have a motion and a second. All in favor? Aye. Before we get started with our agenda, I'd like to note that we're continuing with the new testimony process that we introduced at our annual meeting this past November. Anyone in the audience who is not scheduled to speak on an issue can fill out a testimony slip stating who they are representing and what their position is on an issue. The testimony slips can be found at the speaker table. After completing this slip, you can submit the slip to me or Jack, and it'll be incorporated in the next meeting minutes after the meeting. You can feel free to submit a slip on any issue. It doesn't necessarily have to be a modern law or a resolution. And I'd just like to remind everybody that to sign in at the registration table, program evaluation form will be sent electronically via SurveyMonkey. Please fill that out. That means a lot to the people organizing this. CE, CLE, continuing education, there's forms for sign-in for that and at the desk prior to coming in as well. Your license number is required if you can do continuing ed. All right, today we're going to start with the annual State of the Line presentation from the National Council on Compensation Insurance, which serves as an update on the status of trends in the workers' compensation insurance marketplace. With us today is Jeff Ettinger of NCCI. Jeff, thank you for being here. And please go ahead with your presentation.
Okay, thank you. Can you hear me? Good morning. Well, let me just start off by saying that the state of the workers' compensation system is very strong. In fact, the state of the workers' compensation system has been strong for many years, as you will see. And I think once I go through some of this information with you this morning, I'm hoping you'll agree that we feel that the workers' compensation system will continue to be strong for the foreseeable future. One way of measuring the strength of the workers' compensation system is by looking at the combined ratio, which is simply the ratio of the claims that are paid out relative to the premiums that are taken in and the expenses that go along with that. You're looking here at a 20-year history of calendar year combined ratios. The latest combined ratio is an 86%, up to 2% from the previous year, which basically means a 14% underwriting profit for the latest year. This is 7 straight years of the combined ratio being less than 90% and 10 straight years of underwriting profits. These are the components that would go into the combined ratio. As I mentioned, the loss ratio, underwriting expenses, loss adjustment expense. Most of the components are staying very stable. Just the loss ratio ticking up slightly. But again, this is the 7th straight year of loss ratios being under 50% for workers' compensation. This just shows the gain on insurance transactions, the latest year being 9% on investments, a bit below the long-term average of 11%. But when you combine the return on investments with that 14% underwriting profit, you're looking at a pre-tax operating gain of 23%, down slightly from the previous year of 25%, but still well above the long-term average of 13%. So workers' compensation profitability, it's got to be driven by the premiums that are taken in. And in workers' compensation, premiums are based on employment and what those workers are paid in payrolls times the rate that is charged by insurance companies gets you the written premium. So the one thing that you would notice here is that during the pandemic, the premiums did drop off due to slowdowns in employment that we all know about and remember. But for the latest year, we're looking at a combined premium between private carriers and the state funds of $48 billion And you can see they're basically back to the 2018 pre-COVID premium levels. So as I said, premium is impacted by the payrolls that are paid to employees, to workers. And for the latest year, the payrolls growth has been very strong, with two things contributing to that. So we see here a 6% increase in payrolls for the latest year being driven by a 4% increase in the wages that are being paid, and a 2% increase just in the level of employment alone. You can see there that the wage rate is pretty consistent across lots of different job classifications. The employment changes vary a little bit. You can see there with strong growth in leisure and hospitality, but not strong growth or even shrinkage in transportation and warehousing. So there's been a very small change to the overall premium for workers' compensation. I just talked about very robust growth in payroll, but the offsetting part of that has been what has happened to the loss costs, or the rates that are being charged. So we're seeing kind of almost an exact offsetting between those two things. There are some other factors, which I won't get into, that slightly are driving up the overall premium, but for the most part, staying relatively stable. So this shows what NCCI has been doing to the loss cost levels in our states. So for 2024, most of our jurisdictions, we've been filing loss cost decreases, and overall, that has added up to a negative 9% in the loss cost level in our states. And the previous year, as we saw, was about a negative 7%. This just shows for all the states where NCCI makes a filing last year, the changes in loss costs varied from negative 0.5% in Virginia to a negative 19% in Maine, but all of those filings you can see were for decreases in the loss costs. It's also helpful to look at the residual market at this stage, only because it can tell us how the health of the market is going, because the residual market is where you would have to find coverage if you could not find coverage written voluntarily. And you see there that there have been times in the early 2000s where the size of the residual market was fairly large, over $1 billion. The last year, the size of the market is $700 million, down from about $800 million the year before. And that basically translates to a 5% assigned risk market share, which is very manageable. So this is telling us that 95% of the time, based on premium, coverage is being able to be found written voluntarily, so the market is competitive. So that was premium. Now it's helpful to look at the loss side of it, so the claims payments that are going out. And the first thing that we like to look at is what we call claim frequency, which is just another way of saying the number of workers that are injured relative to how many workers are on the job. And you will see for this 20-year history that most of the time we have seen the claim frequency drop from the previous year. And actually the latest year, the claim frequency decreased by 8%, almost twice the annual average of about 3 to 4%. This is good news, just showing us that workplaces continue to get safer and injuries continue to go down relative to employment. So the other side of a claim payment is, once a worker is injured, what is happening to the average claim payments for both the medical component of the claim and what we call the indemnity or the wage replacement part of the claim. So what we term medical claim severity is the average medical cost for each lost time claim. And we are seeing there that in the latest year, the average medical component went up about 2%, and the previous year about 3.5%. So, you know, we've been living in a kind of these last couple years of a high inflation environment where things like our groceries and some of our other insurance costs, like car insurance and things, are going up at quite a higher rate than we're used to. But in workers' compensation, when we compare the medical claim, average cost per claim, it has been tracking relatively close to the wage levels and relatively close to what we term kind of a medical CPI, so not exactly what we usually think of as a CPI, but we call it here a personal health care price index. So one of the reasons that the medical costs in workers' compensation have not, let's say, gone up as much as you would think things go up in the general, economy, is that almost all states have medical fee schedules in place where the amounts that are paid for certain things are set up by statute, and that helps to control how much costs increase for medical in workers' compensation. So then on the indemnity, the wage replacement side, when a worker is injured, they get a certain percentage of their wages. So you would think that as wages increase, then the indemnity claim severity would increase as well, and it has been. So the last 2 years, up 7% and then another 5%. But again, when you compare that increase over time in indemnity versus wage inflation, it actually has increased slower, much slower than wage inflation. So overall, when you add those two things together, the overall claim severities have been going up about 3%. I'm going to call that a pretty moderate increase in the amount of those payments. So let me just recap some of the things that we've seen here. The lowest combined ratios that we've seen in decades, under 100 and now under 90 for 7 years in a row. A very slight change or increase in the written premium, driven by, we see strong growth in employment, strong wage growth, but we see loss cost decreases, which are kind of offsetting that. Those loss cost decreases are being driven by safer workplaces, so claim frequency decreasing, and then moderate increases in the average costs per claim. And that is putting us in this environment where NCCI has been filing and expect to file decreases in the loss costs as the claim payments do not keep up with the increased premium as payrolls increase. Are there any questions?
Thank you, Jeff. Legislators, Senator Lehman.
Thank you for the demotion. It's Representative Lehman, but that's okay. A question that was not on your presentation, but it's an issue that we've had, and I've tried to work on this in Indiana, and it is with experience modifications. So we've had two situations now where this is real life situations where someone had a claim, a large claim, not at fault in an auto accident, but it was work related, so it was not at fault. It hits their modification because it hits their work comp. They paid about $60,000 in additional premium over the 3 years of their experience mod increase. It took 5 years to finally get subrogation. They got their subrogation, and no one was going back and recalculating the mod. So what we found is there was really no mandate that you had to recalculate the mod. Well, the concern was the carrier got all their money back, But how did the insured who paid out the additional $60,000 on an experience modification that was not their fault, they didn't get their money back? Has NCCI ever looked at putting some standard in place that says, if you go back, if you are successful with subrogation within so many years, you have to go back and recalculate their mod and refund them back any money that you collected?
It's an interesting scenario, and I'm not aware of the time period. Like you say, there's a time period where you can revise the data for up to a certain amount of time, but after a certain amount of time, I'm not aware if you can go back and do that. So it is an interesting issue. I don't have the answer for you. I can.
So we've tried to do this legislatively in Indiana. The pushback has been, because there's always two parts of this. The other part was experience modifications driven by your claims, and a lot of public contracts and large contracts will not allow you to even bid a project if your mod's over 1. So you have some people who are very sophisticated, they're very large contractors, and they're presented with a $10,000 loss, and they look at that and go, if I calculate that into my mod, I'm gonna have a 1.02 mod, let's just pay that claim. And it's not, they're not allowed to. They can pay their own claim, they have to disclose it, which in fact could hit their mod. But so they're doing this, and I think it's tainting the modification process. So we've tried to take out the bid requirement. And then part of that was also with the recalculation of the mods. But we hear from the carriers, we already do this, but they'll do it like back 2 years. So in this case, the trucking company lost $60,000 and would have gotten about $25,000 back, while the company was made whole. So that's my only concern, is we're making the carrier whole through subrogation. There's no time frame on subrogation. I could be successful 7 years from now and get my money back. Now, it's money I didn't get interest on, et cetera, but I got all of what I paid out back. And the individual who I paid that mod did not get that. That's something I guess I'd like to see NCCI maybe give some guidance to.
The one comment I will make is that we have been vocal and published research or saying that the mod should not be used for those types of things, to, whether someone gets a contract. Mods over 1 aren't necessary. It does not necessarily mean that is a bad employer, a bad risk. And so we have tried to put some numbers behind that and some theory behind that as to why you can have a mod above 1 and still everything. So that is something I think that, if that can be handled legislatively to not allow that, that's one thing that we would definitely be behind.
Thank you, Senator. Representative Tedford. Good morning.
One observation that I had on this is that the fact that the loss costs have been dropping over the last couple of years, it has made, in my opinion, the E-mods more sensitive to claims, and now you're getting a higher mod from the same claim that you would have gotten a couple of years ago, and it has made these contractors that have been under these type of provisions where they have to keep their mod under 1 and very sensitive to that. So you're saying that you would support any type of initiatives to prohibit that type of arrangement in a contract? Is that what you're saying there?
Yeah, I mean, obviously we're not lobbyists, but we have published information on our website saying that the mod should not be necessarily misused for those types of purposes, that there are reasons why a mod above 1 is perfectly acceptable. The other thing I will say is, when loss costs decrease, it doesn't necessarily mean that now the mods are getting bigger. I mean, everything adjusts along with it, so that the experience mods overall should still remain about the same, even during a decrease in loss cost environment.
So maybe, and just kind of maybe a follow-up to that is, as they go through this process of recalculating things like that, one of the things that we've looked at from a claim standpoint, and I guess I'd like to know if you have data behind this, as you went through the fact that Indiana is no exception, we've lowered rates the last, I think 11 years. It's created some disruptions in the market, but it's good. However, the one thing we did do 11 years ago was we capped reimbursement to hospitals because they had no fee schedules. And so they were like, there were some of them that were 800, 900% of Medicare. We capped everything at 200% of Medicare, and things dropped like a rock. So on some of these, the rates or the premiums or the losses are going down. How much of it is, better loss control and things like that, which there is, and how much of it is what states have implemented in some form of fee schedules? You know how many states have a fee schedule on workers' comp?
I mean, roughly, out of the 38 states where NCCI files a loss cost, I would say 36. I'm just going to throw that out there. Like almost every state has some kind of fee schedule. There might be one or two that don't. When you look at the decreases that we're filing, very, very rarely is it due to a new fee schedule or a large change. I think those changes are made all the time. I would call them more tweaks here and there. But those things are not necessarily driving the decreases that we see here. It's really the experience itself.
Thank you, Senator. Representative Carter?
Thank you, Matt. Is it working? Okay, can you hear me?
I can hear you.
Okay, thank you very much. It's my understanding that the NCCI provides fair systemic data to everybody involved. I want to know if this data is being given to the general working group. In other words, healthcare providers, insurers, and even some injured workers providing to the system. What kind of system do you have for an output so everybody knows the end result of your analysis? I applaud what I saw today. It's very good. Now I need to know what the workers, if the workers are getting this data.
Okay, so her question is, we get a lot of data, do we give it back? I would say, what I would call raw data. No, we do not, collect data and provide raw data back to workers or to, insurance departments, but obviously summarized data and that you see here, or even data used in research, we provide back. But it's important to keep that information secure and private, because a lot of that information is private information. So.
Well, I guess my question is not so much the detailed data. Okay, I understand that. But just a general overview of like what we have right here. Is that disseminated to, I would say, workers?
Yes. So this information. So by the way, we just we finished up our annual meeting in May, where that's when the results become available, and we present that information to almost 1,000 industry people. And as soon as that information is presented at our meeting, it is posted on our website where anybody can access it. You don't need a login. You don't need to pay any money. That information and a lot of other useful information is available on our website to everyone.
Thank you, Representative. Are there any other questions? Thank you, Jeff. Appreciate your presentation. Next on our agenda is a presentation on workers' compensation premium fraud in the construction industry. With us here today is Matt Capice of the United Brotherhood of Carpenters and Joiners of America. We'll hold questions until he's finished. Matt, thank you for being here, and please go ahead with your presentation.
Thank you. I'm an attorney with the United Brotherhood of Carpenters, and this issue of illegal employment practices in the construction industry is something I've been tracking since I had jet black hair, and that was back in 1989. If any theme comes out from this presentation, I hope you understand that the status quo that we're facing in the construction industry with workers' compensation premium fraud is unsustainable, and I'm hoping that this is a beginning of a conversation with NCOIL. So how does this happen? How does a construction labor provider operating through a shell company identity that claims 4 workers at $43,000 a payroll in 15 months get 450 certificates of insurance issued to its by an insurance broker. How does this company make $11 million in 15 months without the insurer knowing anything about it? How does this happen? A labor provider that operated out of Tennessee into Colorado and up through Pennsylvania was finally arrested in the state of Tennessee for workers' compensation premium fraud. And when the investigators talked to him, they asked him, well, do you ever declare your full payroll at the beginning of a term, policy term? What do you put down in the application? He said, I never tell them what my real payroll is going to be. And then he was asked, well, what do you do when it's time to renew your policy, when the audit comes around? And he simply said, I just don't answer the phone. I don't set up an audit, and I just go to another insurance broker and get another policy. How does this happen? Now, we're facing an issue in the construction industry where law-abiding employers are being squeezed out of markets because they're not engaged in unlawful practices that lower their labor costs, that allow them to underbid law-abiding employers. So what are some of the numbers? A study was done by the Coalition of Insurance Fraud, and the United Brotherhood of Carpenters is a member of fraud in the construction industry. And claimant fraud is a problem. It's a $9 billion problem. But employer fraud is a $25 billion problem. It's much, much more severe. And unfortunately, it seems like claimant fraud gets the bulk of the attention. Now, in the construction industry, the premium fraud loss numbers to insurers are at a staggering $5 billion a year. Now, this is not just a loss in premiums to insurers. This is a loss in premiums to the administration of state workers' compensation systems, because a lot of our systems in the states are funded by assessments on premiums. And in the state of Tennessee alone, that state loses $13 million a year to fund the administration of its workers' compensation system and their Tennessee Occupational Safety and Health Administration and their uninsured employers fund. How do the contractors do it? Now, the picture you see on the slide is intentional. There is a thought, an assumption that the illegal part of the construction industry is isolated to single-family home construction. Well, the home residential construction is probably the worst of it, but what we are seeing extends to military bases, hospitals, public schools, universities, legislative office buildings, luxury condominium towers. And we're seeing this in every phase of the construction industry, every type of project, in every state in the union. And I'm going to run through the fraud scheme. And as you'll see, this isn't a case where you have people that are confused about definitions of employment. This is organized crime. The construction industry is what we're calling a fissured industry. There are layers, as you know, of contractors and subcontractors. So you have general contractors and owners that hire specialty subcontractors that actually do the hands-on work, the excavating, the pile driving, the electrical, the HVAC, painting, and flooring. And what we're seeing is a lot of these specialty subcontractors are now getting their labor through subcontract labor providers, labor brokers. And at times, these labor brokers will operate through a shell company identity. The labor brokers will 1099 misclassify the workforce, but most of the time, for every one worker that gets a 1099 who should get a W-2, two are being paid off the books. So this is just out and out fraud. So the specialty subcontractor will use a labor broker to provide it, to supplement its labor force, and it will act, if you apply your employment laws in your states, you will see that those specialty subcontractors are just as much an employer of the labor broker's workforce as the labor broker. Oftentimes, the labor broker simply recruits the labor and pays them. The specialty subcontractor will be doing the daily supervision, can even transfer them from job site to job site, could even fire them and have some impact on the wages that they're paid. And in the cash pay system, you could put into this flow chart the use of check cashing stores or money service businesses. And a fair question has to be asked. Is the cash pay system we're seeing growing in the construction industry a way for organized crime to wash dollars? And we have seen in a case a member of a New York City crime family going down to Calle Ocho in Florida, opening up a check cashing store that was being used in this type of organized crime scheme. Now, as you can imagine, workers' compensation costs are very expensive in the construction industry, and those specialty subcontractors realize an incredible decrease in their labor costs, which allows them to underbid law-abiding employers. And these on these job sites that I've mentioned, we have seen some of the largest general contractors, construction managers, and specialty subcontractors in the country where these types of schemes are occurring on their projects. And as you can imagine, there's a cornucopia of laws being violated, not just workers' comp premium fraud, tax fraud, child labor, immigration. The system is very, very good for hiding the employment of undocumented labor that's easily exploitable. We see money laundering, mail fraud, wire fraud, labor trafficking, child labor, and conspiracy charges. And if you don't believe me that this is a problem, take a look at this. The Financial Crimes Enforcement Network, which is a part of the U.S. Treasury Department, has issued a notice to banks and other financial institutions like check cashing stores that they need to start sending suspicious activity reports to them when they see suspicious transactions being undertaken by construction contractors because of the high degree of tax fraud and workers' compensation premium fraud that they're seeing in the construction industry. This notice was filed by this. Every year, the U.S. Department of Treasury issues a National Money Laundering Risk Assessment Report. The construction industry has been cited as being prone to child labor trafficking and for tax evasion and workers' compensation premium fraud. Now, the bad guys, something I failed to mention when I got to that chart, that $450 number, in some of the more sophisticated schemes like we see in Florida, once that COI is issued, that shell company labor broker operation will rent it out to other labor brokers in the region. So this is how an insurer that thinks it's on the risk for 4 people for $43,000 worth of payroll is actually on the risk for hundreds of people with millions of dollars of payroll happening. So the bad guys know what insurers do and don't do, and they're driving a truck through the opening. So some change is needed, and we have some suggestions on what the insurance industry should be doing in order to play more of a role of not seeing itself being taken advantage of and stopping this problem. One thing they could do is they could start tracking the COIs being issued by their insurance brokers. This way, they could catch the fraud before it becomes too large. Right now, there is no tracking. I don't know if I need to explain this to you. You probably already understand that certificates of insurance lack integrity and they could be easily forged. We think these insurance certificates should have some indication of the payroll being paid, being declared, because these certificates are used as a shield against liability for those upper tier contractors. They say, I got this COI, I'm covered, right? Everything looks fine to me. Now, when law enforcement comes around, they are focusing on that labor broker, shell company operation. They're not pushing up the contract chain any of the accountability. And that's why this problem is mushrooming, because right now, when law enforcement gets involved, they are disrupting the fraud scheme. They are not dismantling it. And those upper tier specialty subcontractors simply get another law-breaking labor broker to fill its shoes, or that labor broker will change its shell company identity and keep on rolling. And the COIs play a role in this. So it would be good if the COIs had some payroll amount on them, if they always had classification codes for the type of work being performed, and for safeguards to prevent forgery. How about putting a QR code on them? So a company that's getting these certificates in order to verify that they're actually real can use the QR code to go someplace and see that, yeah, it's a real certificate. Because we also have a problem with employers, upper tier contractors, getting fake COIs, or getting a COI that in the policy was terminated by the holder of the certificate. Other impactful reforms, we think insurers should ask their contractors coming in for policies, well, how you get your labor. And since the use of labor brokers increase risk, if you're going to use a labor broker, you should pay a higher premium. And also, they should start tracking bad employers. Why was that guy in Tennessee able for a decade able to avoid get another policy? Because insurers don't track bad employers. You know, I broke my foot working for the Carpenters Union back in the late 90s, and I'm sure if I got injured again, the insurer can go to ISO and see that I had a previous injury. But there's no tracking of bad employers. And something else that's not on the slide that needs to be mentioned, because these slides are focusing in on internal stuff. You know, externally, to improve enforcement, we think there should be a grant funding mechanism to state district attorneys to pick up these cases, because right now we're not seeing enough meaningful criminal enforcement. And they have a very good system in California for that. So I'll take questions, and I'm hoping this is the beginning of a fruitful conversation. Thank you.
Colleagues, if anybody has questions, please let us know. Representative?
Thank you for your presentation. I have to admit, when I heard this, I am myself an insurance agent from Tulsa, Oklahoma. When I heard your scenario, it triggered me a little bit, because I've seen exactly what you've talked about here. Some of the comments and some of the fixes, as far as the certificates of insurance. Is that certificate that you're requesting being sent that has the payroll, is that from the broker of the labor broker, the insurance broker of the labor broker, so to speak, or all certificates of insurance through the industry?
I don't think I understand the question. When the specialty subcontractor wants to see a COI, and the labor broker will get the COI from its insurance broker and give it to the drywall contractor or concrete contractor. Is that what you're asking?
Well, what I'm trying to make a distinction from is who is sending this certificate is the insurance brokers who is sending the certificate, who's not going to have necessary knowledge about the payroll unless given it by the underlying contractor themselves. And so what I'm suggesting, if the fraud is coming from specifically labor brokers, are you suggesting just those handling the insurance for labor brokers are to do that, or this for throughout the industry as a whole to list payroll on certificates of insurance?
If you want to focus just on the construction industry, that would be a good thing to list the payroll. And insurance brokers have been arrested as part of these schemes. Unfortunately, there is a crop of insurance brokers that do this as part of their business, get involved in these schemes as part of their business.
Follow up, if I may. Do you know if there is among the P&C insurance industry a discussion or a push to create maybe a database of contractors who are refusing to respond to audit or anything? Okay.
No.
Are you recommending that be looked at?
Yes.
Okay.
And on the QR code thing, these fixes, this is stuff I'm making up. I've been doing presentations like this for about a decade. This is stuff I'm hearing from the SIU and the audit side from insurers.
Thank you, Representative. Are there any other questions? Go ahead, Senator.
Yeah, hi. Thank you, Madam Chair. I'm Arthur Ellis. I'm Senator in Maryland, and this past session, I put a legislation, and I was primary sponsor to attack one part of this problem. Going in, I had a lot of support from the unions, and by the time I got to the hearing, only one union showed up to testify because the word went out, don't show up to testify against this bill. This is a huge problem, wage theft, premiums, in this space with this wage brokers and the contractors. And so my question to you is, it seemed like there was a fear among a lot of the unions to really go in and be forceful in supporting legislators who want to attack this problem. Have you seen that particular aspect, what I saw? And if you have, what do you think are the reasons behind it?
I can't speak for other labor organizations. I know I've been hired specifically to focus on this issue, and I know our Carpenter Regional Councils are focused on this issue. And if you're looking for a friend to tackle this problem, we're all in.
Okay.
So
you said
contact us.
So I had the wrong friends to help me.
You may have had the wrong ones, but
Okay.
no. This is an existential problem for us. You know, when you see contractors working on legislative office buildings, and this is happening, you know, something is terribly wrong.
Yeah. Okay. Thank you.
Thank you, Senator. I'll just bring to everybody's attention, the presentations are available online. At the end of the presentations are their contact information, often also, and in this case, websites where further information can be had. Representative Carter.
Thank you, Madam Chair, and I did get the microphone to work. Okay. And thank you for your presentation. I come from the labor movement, okay, and this is disturbing to me to hear that this is going on. And what kind of, like I asked the previous presenter, what kind of effort is being made to make sure that the workers understand what's going on? Because they're impacted by these premium hikes and these shell games, ghost policies, and everything else. It impacts their safety. And safety is number one. What efforts being made to make sure that the worker understands what's going on?
We are on thousands of construction sites a week talking to workers, and we talk about this to the workforce. And I know we're we're doing our darndest, and we have lots of public information available on this for employers to look at, workers. We have Spanish versions of what's on our websites, our website. So I know we're out there spreading the word. Thank you.
Thank you very much, Matt. Appreciate your presentation. I don't see any further, oh, we do have one. Senator.
Thank you, Madam Chair. Larry Walker from Georgia. Just a comment mostly, but in Georgia, and I don't know if this is nationwide or not, but you can go on our State Board of Workers' Compensation's website and verify workers' comp coverage by do a search on the name of the employer. And it's real time. A certificate is just a snapshot in time, as you know, and policy could cancel the next day. And, you know, we put on there, I think we endeavor to let the certificate holder know, but that's very hard to do. But this is a real time verification of coverage. It seems to me at that point, it's on the insurance carrier to do a good audit and verify payrolls. And you know, I think in Georgia, the carriers ought to, you know, they ought to ask for 1099s and all that stuff when they do their audit. And if the company, the insured, is going to, you know, be just totally fraudulent and be a criminal about it and dishonest, I don't know how much you can do. I mean, even if you legislate stuff, you can't legislate people, you know, are going to break the law no matter what you do. But the labor unions in Georgia are very much pushing for the type of things you're talking about, and I have discussions with them every session. But I think our system in Georgia is, you know, working pretty well. There could be more, I guess, surprise type audits on companies from maybe the Department of Labor or something to see if they're just totally violating all kind of laws as far as whether they're considering their people, you know, independent contractors or employees. And we have kind of a 7-point thing to look at to determine whether they're an employee or not. But just wanted to throw that out there.
Yeah. If, for instance, the suggestion that insurers be notified of number of certificates going out would certainly queue them up a lot earlier. And I hate to say it, and, you know, please don't take offense, but Georgia is one of the worst places for this problem in the country. And the enforcement level of the law in this regard, not just in Georgia, but in other states, it hasn't proven to be very effective. So, you know, status quo it's got to change. The status quo is unsustainable for the law-abiding part of the industry. Thank you.
Thank you, Senator Walker. Thank you again, Matt. Appreciate it. Next on our agenda is a presentation on developments in the California workers' compensation insurance marketplace. And with her today is Rena David of the California Workers' Compensation Institute. We're going to hold questions until she's finished. Rena, thank you for being here and presenting.
Thank you for having me. I'm actually going to be focusing, is that working? Can you hear me? There we go. So I'll be focusing today primarily on trends we've been seeing in pharmaceuticals and 5 years out, what the impact has been since the adoption of the California formulary. I'm going to start just by describing a little bit about CWCI. We are a nonprofit research institute, and our goal is to improve the California workers' compensation system. You can see we've been around since 1964, so I guess we haven't accomplished that yet. I also wanted to make you aware of our website. where we have both public and member-only research on a variety of topics I'll be getting into. As legislators and your staff, you are welcome to give us a call and get copies of our member-only research. We like to support the legislative efforts, even if it's not just in California. So you're welcome to come there. We also have a repository of all regulatory activity that's taken place in California, every round of hearing, of comments, and that's open to the public, so you're welcome to go there just to see how California has approached different topics. So we also have on our website research that we've done recently, actually back in years, but we focus on claim reporting activity, trends in average payment and medical treatment. In particular, over the last year, we've done research on inpatient utilization, especially the shift of spinal surgery and major joint replacement from the inpatient to the outpatient setting. And I'm not sure if that happens countrywide, but it's quite accelerated in the last couple of years in California. We also conducted a major study on cumulative trauma claims, which my understanding is in particular a California issue, but I invite you to look at that report. We also often look at regulatory or legislative change and try to measure the impact, some of which I'll be talking about today. So on individual proposed legislation and then our new medical legal fee schedule. So with that as background, let's go ahead and go into the California formulary. So in October of 2014, the Institute did a study where we modeled California utilization against two existing formularies, the Texas formulary and the Washington State formulary, and just measured what the impact would be had California had that into effect. Texas was a more inclusive formulary. Both were based on national drug, NDC, which is a particular identifier for a drug that even includes manufacturer. But with Texas, they allowed more drugs into their formulary, and with Washington, they were quite exclusive, really eliminating many drugs that typically weren't used for workers' comp injuries, as well as some higher priced drugs. So the conclusion from both analyses was that there could be quite an impact of a formulary for California, and not necessarily just related for that reason from our report, but also from other stakeholders. In 2015, AB 1124 was passed that proposed or mandated the implementation of a statewide formulary for workers' comp. And they had two intended goals. One, the primary one was to ensure that the medications provided followed our treatment guidelines and were evidence-based. It also intended to assist with frequency, duration, and strength, along with the appropriateness of the drug. And you'll see, I'm not sure if it quite addressed those areas. And then the second intent was to reduce friction costs associated with the provision of pharmaceuticals in terms of UR, independent medical review, with the hope of reducing both the costs and delays associated with that. So some of the key aspects of the formulary, the primary one I'm going to be discussing a fair amount today is that it is not based on that NDC code that gives you manufacturer, frequency, strength, and dose. It's based on just the drug ingredient name. So it is not as specific as the Texas and Washington formularies. But so basically to be on the formulary, it needs to be mentioned in our medical treatment utilization schedule, which is our treatment guidelines for California. And then once they're in there, the drugs are either exempt from utilization review based on the drug ingredient or non-exempt. Then we have everything else that's not on the formulary. And in the traditional kind of group health world, if it's not on the formulary, you'd really have to go through quite an appeal process to prescribe that drug. Basically, the initial thing would be not to reimburse it. But in this system, basically, the only difference between not listed and non-exempt drugs, they both have to go through prospective UR. But for not listed, because they are not part of the treatment guidelines, theoretically, they need to bring with it, the request needs to bring with it the evidence that this is needed for the patient. So a higher level of requirement to get approved. There are also some special fill, so the first few days of treatment have some exemptions to UR as well as perioperative drugs. So what did we see 5 years out? What we have in green is the share of utilization that was for exempt drugs. And then in kind of the gold color is the share for non-exempt drugs. And you can see since the implementation in 2018, we really saw a tremendous shift between the use of exempt drugs and non-exempt drugs. Not listed stayed pretty flat, going down a little bit. So ultimately, the goal of exempting more activity through UR was achieved. Now, there are other factors that come into play on this shift, but I'll talk about that in a moment. When we look at the payment side, you can see that the share of dollars for non-exempt drugs went down as the share for exempt went up, and the exempt tend to be lower priced drugs generally. But you can see that the brownish line there where it says not listed, even though they only represented 12% of the volume in 2023, they represented 45% of the total drug spend in that year. So those drugs that are really not in the treatment guidelines and in theory shouldn't be part of treatment, they do represent still a large portion of the dollars. As we look at drug utilization in general by drug group, we've seen a tremendous change in the mix of drugs prescribed. Opioids were at one time almost 45-50% of the utilization. It's now down, and I'm sorry, I don't have my glasses, so I have to pull up that slide to see the exact number. It's now down to about 30%. So a tremendous change, and I'll be talking about that more in a moment. And really, the treatment has shifted from opioids to anti-inflammatories. I'm going to take a little side note here on our fee schedule in California. In 2004, there were reforms to have workers' comp payments be based on the Medi-Cal fee schedule, which is our Medicaid program in California. That caused a considerable drop in the average unit price paid for any given drug. They also allowed for generic substitution unless the prescriber said dispense as written, and it had some limits on repackaged drugs. Then in 2012, they put caps on pharmaceuticals dispensed by physicians, and actually pending right now are a new set of regulations to adopt some additional changes that Medi-Cal made in terms of a two-tier dispensing fee and other ways of pricing the drugs. So I bring this up because in many formularies, there's a dual purpose, first of all, of just having only a certain set of drugs being prescribed, appropriate drugs, but it's also to limit costs, where if you have the same drug from different manufacturers with same efficacy but different pricing, you would only want to prescribe the lower priced drugs. That's true of group health and other workers' comp systems where price is a factor in the formulary. In California, that's not the case. It's strictly the ingredient, and because it's not NDC-based, there is no tie between choosing what's on the formulary and a lower versus higher price drug doing the same thing. And what we've seen, we've done several studies on high-cost drugs within the system. This slide is an example of anti-inflammatories. Of them, there are certain drugs that are just 1% of the volume, but represent, that first drug, 33% of the anti-inflammatory costs. This is an exempt drug, and it has the same efficacy as any anti-inflammatory. It's just the pricing model allows it to, it's not part of the Medi-Cal fee schedule, and therefore it has gone from $169 to about $1,500 a script. So pricing, again, is not part of the California formulary. It is impacted by the fee schedule, but there are a lot of loopholes in this category, as well as especially in dermatologicals. And we looked at other drug groups as well, so you can see more of our studies on that. Kind of back to the trends we've been seeing in pharmaceutical treatment, and it's just incredible every time I see this graph of the just tremendous change in practice in the use of opioids. We were, again, up to almost the 50% level back in the 2010s, early 2010s, and now we're down to just 5% of indemnity claims having opioids as part of the treatment plan. That's the same is true of the number of scripts people get once they start using opioids, as well as the strength of those opioids. So we think whether that is actually due to the formulary and the fact that opioids were non-exempt and really demanded more scrutiny, perhaps, than before, or just the general trends in treatment, I think it's probably both. But clearly, this trend in drops in opioid use continues, and we'll show you some statewide data across payers in a moment. Back to the second intent of the legislation, it was to reduce friction costs. We did see an immediate drop in the number of disputes going to the independent medical review process after the implementation of the formulary. About 30% of the UR denials go to independent medical review in California. And again, there was an immediate effect, but again, the fact that not listed drugs can go through as well limits how much that can go down. Also, the share of pharmaceuticals within the independent medical review process went from 50% of the disputes to 33%. All along for from 2005 through 2023, we've seen that once a pharmaceutical request goes to the independent medical review, over 90% of the time, really throughout the time period, those requests have been upheld by the independent medical reviewer. And just another point is that opioids as a share of pharmaceuticals has also dropped over the time period. So I'm going to end with a discussion of some research we've just embarked in using the statewide PDMP, which is it's a monitoring program for controlled substances. Through this data, we're able to look at use of opioids across payers. And we were especially interested in looking at, well, are people stopping opioid use in the comp area and getting it through group health or other means? So when we see the drops in workers' comp, do we also see it in other areas? We're just starting the research. We'll have this published probably within the next few months, but I just wanted to go through a few statistics here. Again, just using statewide data, not just our own database, you can see the tremendous change in the opioid use in California for workers' comp, and then comparing that to total California, so including group health. You know, California is about 1 or 2% of the medical activity in California, but you can see that all payers in all sectors, opioid use has dropped 30% from 2017 to 2022. But for workers' comp, the reduction has been even greater, almost double that. When we look at that by the acuity of the patient, whether they just need it for a short time, a middle time, or on chronic use, again, tremendous drops for all payers, but more so in comp. And then here is just the start of our look at overlaps. In 2017 data, we found, actually, unfortunately, for the same date of service, we found about 8% overlap in the days on opioids from between, you know, some were workers' comp only, and then other payers, they were also receiving pharmaceuticals or opioids for that same day, for that same patient. So that has dropped down to about 3.5% in 2022. But it's something we'll be looking at, and it's, you know, the PDMP itself is supposed to prevent overlapping treatment, but even if it was just the transition period between workers' comp coverage and other, it does seem to be that people are having treatment paid for in the comp system, and then again, additional opioid treatment from these other payers. We'll have more on that over the course of the next couple of months. So in conclusion, after the formulary was implemented, there's definitely a shift in patterns from drugs exempt from UR to drugs exempt from UR from the non-exempt categories. And just the tremendous change in practice with the decline in opioids. And I think we have to think it was somewhat accelerated by the implementation of the formulary and perhaps the higher scrutiny to those opioid prescriptions. And then in general, we're seeing it across all payers, this drop in opioids. And in our prior research, we did find, especially for less acute treatment like low back pain, the introduction of opioids actually worsened the outcomes for the injured workers. Also, we did see the decline in independent medical review that the legislation had hoped for. And just another, again, if you don't have a formulary and you're thinking of implementing it, when it's not based on NDC, there's very little controls you can do over price, over the, you know, especially within the same category, the same efficacy. If you're not setting the restrictions or the view on a specific drug based on the manufacturer and the dose and all of that, it just limits how much it can be used for cost controls, and in addition to just efficacy. So I think that is it. If there are any questions, happy to answer.
Colleagues, are there any questions? Representative?
Thank you, Madam Chair. Just out of curiosity, and if you comment on this, I apologize, but the whole thing was around opioid pain management, prescription drug. Has there been any study done as to what's been the impact of medical marijuana in that space of opioid and pain management?
Well, this is a difficult issue. We did do a kind of a study of marijuana laws across the states, but because marijuana has been a controlled substance, stage, I think it's class 4, if I have that right, it can't be studied in a clinical setting. And even the studies that were done in the past had to use like 3 strains that were developed by the NIH. So it's, and also because we can't use the banking system to pay for marijuana, even though it's legal in California, it's not legal federally for a bank to, you know, be used in the payment of it, we just are restricted on how much we can use. There's been some research on methadone. I think some of the research abilities have been loosened up in recent years, but I think it's not, if a payer is even paying for marijuana for particular patients, that is really going to show up in our data as just a cash payment reimbursement to an individual worker, and we can't identify it in the administrative data because it doesn't have a fee schedule, isn't identifiable because of those federal laws. So it would be great to measure, and hopefully that will change in the future.
Well, I think it would, because Indiana, we do not have medical marijuana, we don't have recreational. We are an island. Ohio just expanded, Michigan's expanded, Illinois expanded, Kentucky I think is medical only. But I've always said work comp becomes the issue because I'm a border community, so I'm 6 miles from the Ohio line. I can have somebody who has a legal prescription in Ohio, or even now can use it recreationally. They get injured in Indiana, it's illegal. They could lose their job, everything else. So I don't know how we're going to manage this data around opioid and pain management when you're seeing more and more of pain management go the route of medical marijuana, and yet as a class 1 scheduled 1 drug in the feds. And I think they're moving to take that off of a Schedule 1 so you can begin to do these studies. But I think it's marijuana is something I think is really tipping the scale when it comes to workers' comp to an extent we just don't know.
Yeah, and I would say that just the combination of Advil and Tylenol instead of opioids has become more of the practice norm even after surgery. And I think that alone has proven to be at least equally effective. With marijuana, I think the other challenge is to have it be regulated. It's a little bit less able to control the quality control, is my understanding. So I think those will all be the challenges. Yeah, it was Schedule 1. I went the wrong direction on the number. But I think that definitely is, in theory, something that needs to be studied for pain management. I think there hasn't been enough study to say whether that's true or not, that it's an effective treatment.
Thank you. Thank you, Representative Lewin. I think we're finished. Thank you. Last on our agenda is the consideration of the readoption of the NCOIL Workers' Compensation Drug Formulary Model Law. You can view the model in your binders on page 163 and on the website and app. Per NCOIL bylaws, all model laws must be readopted every 5 years or else they sunset. This model, or something substantially similar to it, has been adopted in 11 states. Before taking any questions on the model, with us here today is Brian Allen of Enlight Pharmacy Solutions, who would like to make some brief remarks. Brian, thank you for being here, and please go ahead.
Thank you. Thank you, members of the committee. My name is Brian Allen. I'm the Vice President of Government Affairs for Enlight Pharmacy Solutions. I have about almost 40 years of experience in the insurance world and workers' comp. The last 20 years spent advocating around the country for workers' comp issues, primarily around pharmacy and medical care to injured workers, and former state representative in Utah. So although I am a recovering politician, I'll be remarkably brief. I just want to enlist your support for reauthorizing the model law. About a third of the states have adopted some form of a formulary. We are very supportive of that. We have seen in our own data, and I'll echo what Rena said, that we see a reduction of opioid use. We also see just an overall reduction of drug use, and which we think is important. And one of the goals that I think should be in any workers' comp system is that we're delivering the right care at the right time for the right reasons. And a formulary, as it relates to pharmacy care, does that. And there are things that you can do with a formulary to help reduce some of what we see are outlier abuses. Like, for example, in Texas introduced their formulary, it was going along really well. We suddenly started to see an increase in very expensive topical creams. We were seeing bills for $14,000, $15,000 for a month's supply of a topical cream, which is ridiculous. for something that you could probably buy at the local drugstore for $20. So we were able to use the formulary to implement some restrictions to make sure that prior authorization was required. So there's some checks and balances that happen up front before that happens. So there's some very positive things that come from using a formulary. And it's kind of funny, we're here advocating for this because we make our money when a drug is dispensed. But yet formularies actually reduce the number of drugs that get dispensed, so we're sort of cannibalizing our own business. But the reality of it is it's the right thing to do. I mean, the bottom line is it does save cost. I mean, if it's done appropriately, it can save cost. But the bottom line is on a drug formulary is you're doing the right thing for the injured worker, and we think that's important, and we support that, and we urge your support for the readoption of this model law.
Thank you, Brian. Colleagues, are there any questions on this model law prior to its readoption? I don't see any, so I'll take a motion to readopt it. Thank you, Representative Carter. Thank you. All in favor? Aye. Any opposed? The model is readopted. Thank you, everyone. Is there any other business? So I can keep you guys sitting here for a while, and I'm feeling very powerful. Is there a motion?
Motion to adjourn.
We have a motion and a second. Thank you, Representative. All in favor? Aye. Thank you all for being here this morning.